see how we get on. So for the last time, let's just remind ourselves of how the market moves. It moves from a support to a resistance, and then back from a resistance to a support. So the market trends between a support and a resistance on any commodity, any futures, any currency pairs that we may be seeking to trade. Moves from support to resistance, resistance to support, until bullish news occurs, which may cause the price to break through a resistance. Bullish news is positive news where market makers are positive about the economy of the country that has issued the currency. So, for example, if there's all positive news about the pound, so let's say we discover a vaccination to COVID, we also receive news that Brexit has been resolved, that an agreement has been reached. That would be bullish news for the pound. So the value of the pound would rise, and we may break a resistance or two to start trading between another support and resistance above. On the other hand, if we hear bearish news about a commodity or an instrument, so we hear that the UK has decided to go for a no-deal Brexit, then that would result in the breakage of a support, and the price would reduce, the value of the pound would reduce, and the price may start trending between a lower level of support and resistance. So again, we remind ourselves that we buy at a support and we take profits just below a resistance, and we sell high at a resistance and take profit just above a support. When we're buying at a support, our stop loss must be below the support. So if we're buying at C being a price point on a chart, if we're buying at C, which may be 1.300 on a GBP USD chart, which simply means that if we want to exchange £1 for the dollar, we would receive $1.30 in exchange. So we're buying at a support at the price of $1.30, and with the assumption that the price is going to rise to $1.40, for example. To prevent our account from being wiped out, to prevent us from receiving a margin call in the eventuality that the price does not rise as we assumed it would, but instead starts to fall, we use a stop loss, which we place below the support, and that stop loss will then withdraw our stated amount, our calculated amount, from our equity and leave us with funds to trade again. If we're selling from D to C, let's say we're selling from 1.400 to 1.300. Having done our analysis, and we assume that the price is now going down from 1.400 GBP USD to 1.300 GBP USD. What we do is we place a sell order at 1.400, although we don't use psychological numbers, which are round numbers, but we're just discussing this theoretically. We place a sell order at 1.400, and then we could place a stop loss around 1.4020, for example, just in case the price continues to rise rather than fall in our assumed direction. So we place, when we're buying, a stop loss below the support. And when we're selling at the resistance, we place our stop loss above the resistance. So now let's take a look at the Forex trader's psychology. So it's really difficult when trading, in many instances, to actually be or to remain objective. It is really difficult sometimes to remain objective, to separate our emotions from our actual trades. So it's difficult sometimes, or it can be difficult, to separate our emotions, to adopt emotional intelligence when we're trading, to view it as a business. So here are some of the psychological traits that can actually impact upon our trading. Overconfidence. So we've built up our demo account. We've practiced our strategy. We've made consistent profit. And so we think, I'm now ready to go live, and I'm going to recreate that exact strategy. One fact that we've gleaned over the years where we've been training and trading, so training as well, one fact that we've gleaned is that delegates don't necessarily follow the same strategy that they've adopted throughout their demo sessions when they've been learning. So they will learn, and they will learn quite well. They'll practice, they'll learn, and then when it comes to live trading, because we're now talking about real money, they become overconfident. And that also occurs to professional traders as well, who go into banks, investment banks. They become overconfident. Another option is, or another trait is greed, where we think, I want to take every last dollar off the table. I don't want to leave a dollar for the market. So we see our take profit approaching, our take profit amount approaching, and we think, you know what? I think this market is still going up. This price is still going up. So let me move my take profit by about another 50 pips. And then the market reverses. So where we should have taken our profit, where we should have banked our profit, sometimes we don't do that out of greed. Again, revenge trading is another trait that some traders may actually adopt, whereby you've gone into the market, you've placed a trade, you've lost money on that occasion. Rather than close your system and evaluate where you may have gone wrong, we find traders immediately going straight back in to try and recover their losses. And in most cases, when you go in instantly after a losing trade, you end up losing more, because that action would suggest that you haven't actually planned that second trade. You haven't done any analysis, but all your mind is focused on is recovering that loss you've just made. Whereas it's better to walk away, go and conduct your analysis, do your lessons learned. It doesn't need to take time. You can spend 15 minutes just saying, okay, I should have observed this sign. I should have observed this candlestick that was suggesting that the market will be going down. I should have checked Forex factory news. I should have checked the calendar to see what news is being released about this equity or what's going on. For example, in Nigeria, which is a large oil producing country. So if you're trading crude oil or Brent oil and you suddenly see the price falling, if you haven't checked the news, you may not appreciate that, okay, that there are currently protests and demonstrations in Nigeria that may affect the output of oil from that country. So when we trade out of revenge, we end up losing more than we gain. Another critical psychological trait, and I'd say this without any fear or favor, but this tends to affect women more than men. Although overconfidence and greed tends to affect more men than women. But with women, we tend to procrastinate, we tend to fear and think, okay, I don't want to lose a penny. So I'll wait until the price hits my exact pip, right? I mean, it gets to my exact price. Rather than use a stop loss, we want the price to reach our exact entry point. So rather than say place a trade at 1.3020 for the system to buy, a pending order for the system to buy at 1.3025 or 27 or whatever, we tend to place our trade at 1.300. And then we miss that order because the price may just go to 1.3005 and then reverse. So a better way to trade might be to place that pending order at 1.3030 and then use a stop loss. So that if it breaks the support of 1.300, then it stops you out of that trade. And then you just do your analysis. And I think that it will be a good idea for us to practice our stop loss placement, practice that and practice that again on the demo before we go live. Because if we're confident in placing our stop losses, then that will reduce the fear. Once we get accustomed to placing our stop losses at the right place, and we're not being stopped out frequently, then that will reduce the fear of using those stop losses. I've often heard delegates say, oh, I don't want to use a stop loss. It's not a good thing to use because it means that I will lose money. But it is there, stop loss is there to protect our equity, not to take our money, but to protect our equity, to reduce our losses. So fear and procrastination those are other psychological traits that can have a negative impact upon our trading because we tend to miss a lot of opportunities. And again, if we remember, I've mentioned that we should learn to reward ourselves from our trading. So the idea of trading is not that we just build up money in our trading platform in MetaTrader for a year's, a year's worth of funds in our equity, rather, in our MetaTrader with the broker. Rather, the idea is to constantly reward yourself, to incentivize yourself to keep trading, to keep practicing, to keep getting better at it. So if by procrastination, having spent time analyzing the market, planning our trade, so let's say you spend an hour on a Saturday planning your trades for the week, and then out of fear, you don't actually place that trade. That means that you're not getting rewarded for that Saturday that you spent, for that hour on Saturday that you spent planning your trade. And then number 6, impatience and over eagerness, for want of a better word. Sometimes we can be quite impatient. So we know where the price is headed to, but we think it's going too slow for our likings. So we end up placing a trade before it's gotten down or up to where we want to buy or sell from. So patience is key. So here again, as I've said at the beginning, that trading can be the easiest skill that you'll ever learn. And yet it can also be the hardest part being the discipline. So let's take a look at all of the mistakes that we can make as a trader. Over trading, where we spend 10 hours a day on our laptops or PCs, just trading, trying to make every single penny that we can make. Remember, I said from the onset that $5 trillion is traded every single day. And that can only get larger. That sum can only get larger because 7 years ago it was $3 trillion a day. So there's absolutely no need for us to overtrade, for us to spend 10 hours a day. Again, remember I suggested that we need to learn to reward ourselves when trading. So if we're trading 10 hours a day, then you need to make sure that you're making at least 150 a day, at least, as a new trader, because that's rewarding yourself by £15 an hour. So don't overtrade. Just trade to the extent that you can actually say, yes, that I've rewarded myself with $30 an hour or $50 for the 1 hour that I spent doing my analysis and spent sitting down on my laptop. Spend 2 hours a day, 3 hours a day. Even if this is your sole job, you can spend many hours just observing the market. But the minute you start placing multiple trades, which we refer to as scalping previously, you're over trading, and the market tends to take back any profits that we've made from scalps. The market will take it back because when the market suddenly reverses and we don't have a stop loss in place, then we lose everything that we've gained and potentially more. Again, Another mistake that we make is to not conduct any research at all, or any analysis at all, and to simply take a gamble or a bet. I think this is what the market is going to do. And that's why a lot of individuals that I know will say to me, no, I don't want to trade because it's simply gambling, which it can be. But it's only gambling if we turn it into gambling ourselves as traders, where we're not conducting any research, we're not doing any analysis, we're simply waking up and saying, I think this is what the market is going to do. I think. But thinking isn't good enough if we want to be successful traders. We have to conduct that analysis. We have to understand what the market is doing. And we don't go live until we've observed the news, we've observed the fundamentals. Otherwise, we will get burnt. Another mistake is not promptly withdrawing our profits. So we build up our account, build it up to $2,000, build it up to $3,000, $5,000, and then we start trading. We start becoming overconfident. We start over trading. We start using high volumes. So instead of trading the usual $1 per pip move, we start trading $50 per pip move on a 5K account. Not appreciating that if we trade $50 per pip move and that trade goes against us by 100 pips, then that's it. We suddenly have no account. And I really, really want us to be in a position where we can say that I have never had a margin call. I've never experienced a margin call where the broker has to close all of our trades because we haven't used a stop loss, or we haven't calculated our trades, or we've over leveraged. So if we promptly withdraw our profits and reward ourselves, we get to a point where, so our first few months as a live trader, I'd suggest that the minute you double your account, simply withdraw your initial equity. So at least you can say, I haven't lost anything. Withdraw your initial equity of $100 and then start trading on your profit and withdrawing your profit. When it's sizable enough, you withdraw that profit and you start again. You pay yourself and you start again. Another mistake is to move our stop losses. If we've calculated that trade, so we've calculated that if this trade goes against me, that I could lose $5. If this trade hits my stop loss, I could lose $5 from a $100 account. So you place your stop loss in the right place, and then you see the trade approaching there. And then you now move that stop loss to minus $10. And then you see it approaching the $10 and you move your stop loss to minus $20. You see that approaching and you keep moving until that margin call comes. So if you've done your analysis, you've concluded your analysis, you've calculated your trade carefully, and you've made up your mind that I'm only willing to risk 3% of my account or 5% of my account, place your stop loss there, close your laptop, and do not touch that laptop again until the traders either closed out in profit or it stopped you out at a loss. Self-deception, sometimes we think that we're actually better traders than we are, that we know it all, that we totally understand the market now, and we will never, ever move our stop losses. Or sometimes we think, I am so risk adverse, because I definitely started thinking that way when I first started, thinking, oh, that I'm so risk adverse that I always calculate my risks anyway. And yet I found pretty early on in my trades that I wasn't risk adverse. I remember one day, this was actually, I think it was my first day of trading. My first day of trading, 2009, I think it was, or 2008, one of those years. But what happened that day is that I left the house. So I spent all night watching my trade because it was first going into my, and I didn't have a stop loss, admittedly. So I didn't have a stop loss. The trade was going into minus $10, and it was a 1K account, live account. The trade was going into minus $10, minus $20. And so I went to work that day thinking, okay, when I get to the office, that it would have gone up to $100 and I'll close it. And I left thinking I'm going to be the first person ever to make $100 on my first night of trading. I didn't sleep all night. By the time I got to the office, that trade was at minus $300. And I was just horrified. I was just there panicking, thinking, I don't want to lose $300 in a day. Then at around 1:30 p.m. or something, and I was working in an office with M's at the time. At around 1:30 p.m., I had my trading laptop, my personal laptop, underneath my desk in that office. And I suddenly saw the trade that was in minus $300, and I'd moved my stop loss to break even at this point. I was just praying desperately that, goodness, that if this goes back to break even, that I'll never do this again. I'll never think I'm a good trader again. I'll always learn. I made so many promises to God that day. And then at about 1 o'clock, I just saw a massive fall in the cable GBP USD, and it went back to my stop loss at break even, and then it even went further beyond that. It broke through many supports that day. So if I'd actually left that stop loss open, I would have made a profit. But I was just grateful that the trade actually closed me out in break even from minus 300, minus 500. I was thinking, oh goodness, this is not good. But then when I got home that evening and we were checking Forex Factory, like what on earth happened there? All that had happened was that there was a rumor. There had been a rumor that Gordon Brown had resigned that afternoon. And it was just a rumor, but it was enough to spook the markets for cable to drop by over 1,000 pips that day. So we shouldn't deceive ourselves. We shouldn't think that we're better traders than we actually are, or that we've attended a workshop. So we think, including myself, that we know it all, because you can never know it all. Remember, professional traders lose sometimes. Sometimes I see these big banks make announcements that we've got that this is what the market is going to do, that it's going to get to 1.300 cable GBP USD, going to get to 1.300, and there are definitely buyers there, or we have bought from there, or we have placed some limit orders down there. So they make those announcements publicly, and then the trade goes against them as well as us because we've listened to them. Or in some cases, we may not have even heard them say that or noted or read that they've said that. We've simply done our analysis. But it's great to accept that we can sometimes be wrong. That's essential as a trader, to sometimes accept that we will be wrong in our analysis. Another mistake is to add to losing trades. So again, without a stop loss, you can see that the trade is going against you. And then you place another trade in the same direction. And that then starts going against you as well. So we never add to losing trades. Over leveraging is another mistake. We can over leverage by simply using too high a volume or a lot size. And we shouldn't do that. We shouldn't open multiple trades. Let's learn. Let's spend a lot of time learning, including when we start on the live trading business. We shouldn't over leverage, and we should calculate each trade. So this isn't something that we're told anywhere else, but this is just something that I do. I'll calculate every single trade to the penny. I'll make sure that I calculate every single trade to the penny on the demo and when I was trading live, just to make absolutely sure that I've got my stop loss in the right place and that I'm not over leveraging with my lot size. Sometimes we place a too tight stop loss, which again is due to fear, where we don't actually view what's happened previously. So we don't actually draw our trend line at the right place, at a support, and then place our stop loss below the support. So we need to make sure that we're calculating our stop losses. We place it above a resistance, not at a resistance. Else we're likely to repeatedly get stopped out. And then another mistake that traders make is to not have a trading plan. And we'll take a look at a trading plan further on. So here's what the disciplined trader does always. So we always use a stop loss. Develop a trading plan before you go live. And if in doubt about the market movement, then stay out of the market. We stay out of the market. There's no harm or no damage to your account if you stay out rather. If you stay out of the market, sit on your hands, stay out of the market. You don't have to trade. Or if you feel that you have to trade, the market is really volatile, then you simply trade on your demo. Because even when you go live, you can have a demo platform open still. But if in doubt, stay out of the market, sit on your hands. And if you can't sit on your hands, then close your laptop and walk away, or close your laptop and simply listen to Bloomberg. But don't feel compelled to trade. Don't feel that you have to trade for any reason. And one issue that we need to remember is that if we feel that we have to trade because we have to make money, that is the best time to not trade. Because when we're trading out of anxiety or out of desperation, we're bound to make mistakes. because we're trading with our emotions. And we shouldn't be trading money that we can't afford to lose, which is again why we recommend $100 when you go live, $100, because some people will find that more affordable than opening an account with $1,000 and losing that. So remember, a micro account, and you trade without emotions. You trade as a business professional, as a professional trader. If in doubt, we stay out, and we have to stick to our plan. We'll talk about a trading plan later, but once we've developed our trading plan, we stick to that plan. If you've drawn up a weekly plan, for example, on a Saturday, then stick to that plan for the week. Don't move from that plan. Don't try and deviate from that plan, because you'll run into trouble. Because if you've done your analysis, you've conducted your analysis, and you've thought, okay, this is what I'm going to trade. I'm going to buy this currency. I'm going to buy this. I'm going to do that because that's at an historical high, for example. Don't then go and trade something else during the week that you haven't planned to trade. We never move our stop loss. I can't, belabor that point anymore. And we need to review our account history each weekend and at the end of each month to learn from any mistakes we've made and to repeat good practices. Anything that we've done that has resulted in profit, then we repeat that. We perfect that. But if we've made a mistake, say, for example, we've traded on the first Friday of the month, which is the non-farm payroll day, then we need to learn from that mistake so that we don't repeat it. We can add to a profitable trade. So if we've opened up a trade on cable, for example, at 1.300, and it's given us $100 profit, we may want to close 50% of that trade and bank that, and then we may want to open up another trade with reduced volume that doesn't take away the $50 that we've made if we believe that the trade is going to continue to go up in our direction towards another resistance. But we never add to a losing trade. If we're losing, if the trade is in negative, we don't add to that. We shouldn't spend all day watching our laptop as disciplined traders. We plan or calculate each trade, as we said. We never go straight back in after we've lost money, and only take calculated risks where you've calculated every single penny of your trade. How much can I afford to risk on this trade if this trade were to go against me? How much would I have left in my account to trade again if this trade were to stop me out? So we calculate each of our trades before we place these. Now let's take a look at running a sole trader profit and loss trading business. So we'll discuss the business plan, the trading business plan now. Profit versus cash. What do we mean by profit v cash? We'll take a look at risk management briefly. We'll practice a trade again. We'll take a look at stop loss management, and then we'll discuss things such as anti-money laundering and Forex and insider dealing and Forex. And when should we go live? So, what is a business plan? A business plan, whether it's a Forex trading business or a car washroom business or a cafe business, the owner of the business has to prepare a business plan, else there's very little chance of success. If the business plan or the business strategy is to simply make it up as we go along. So the business plan that you'd be creating will be detailing the short and long-term goals and vision of you trading the Forex market. Your long-term goal may be to retire in 2 years or 5 years' time and trade Forex as a day trader. Your long-term goal may be to pay for a holiday for your 40th or 50th birthday, for a cruise. That may be your goal. And that's fine as long as you've stated that in your business plan. Why are you trading? Why exactly are you trading? What are you trading for? If you document that, that will help to steer your trading decisions. When you remember that I'm trading so that I can pay off my mortgage in a year's time. I'm trading so that I can do X. I'm trading so that I can do Y. So in your business plan, you detail your short and long-term goals. You detail the why. Then you detail your initial investment. How much are you going to place down in MetaTrader with your broker as your initial investment? Remember, I'll keep repeating this until the end of the course. $100 is enough. Don't let any broker tell you that it's not enough, that you have to start with a minimum of $1,000. I actually saw, and I'm not sure whether this was accurate or not, but FXCM, a broker, I noticed a few weeks ago that they offer a trading account, a micro trading account, starting with $5. So for that, you'd definitely be trading 1 cent per pip move until you build that up to 50 cents, or until you build it up to 100 cents, and then you build it up to 1,000 cents on whatever. But sorry, $1,100. But the fact remains that you need to document your initial investment so that when that temptation comes to add more equity, because you haven't calculated your trades and you're approaching a margin call, your business plan, your documented business plan will remind you that you have said that you're only going to invest $100 in this. So why are you ringing up your bank, or why are you trying to add more money into this, more equity into this? Why are you trying to add funds from your credit card into this? So document your goals, your vision, your mission, the why you're trading. Document the initial investment and don't shift from that. Document where you'll trade from, where you will trade from. Are you going to trade from your living room? Are you going to trade when you're on a train? Which again is a no-no as far as I'm concerned. Number one, because it's unlikely that you would have planned that trade if you're simply trading on the move. And number two, your signal could cut off before you've had the opportunity to place a stop loss. And in a volatile market, again, you could get stopped out. So where you're going to operate from, you document that. When you will trade, between what hours? Are you going to do the Asian market? Or are you going to do the times between 8:30 or 8 o'clock and 1 p.m. before the US opens, but when the UK opens? So you document when you'll be trading, when you'll be doing your analysis over the weekend or before the market opens. Could be Friday night after the market is closed. You review what's gone on the previous week and what your expectations are for the following week. Then you also review what products you will be buying. So what instruments you'll be buying. You may find from your practices and from your demo trading that you prefer to go for a currency pair that isn't too volatile. You may decide that you'll only be trading the commodities such as gold or silver. Whatever you decide, document it in your business plan. Document your expected return on investment. That, okay, I'm investing $100 today or when I'm going live. How much do I expect to reap as a return in month 1, in month 2, in month 3, in month 4? So you document all of this, and when you've reached your goals, let's say you've reached your expected return on investment, you've reached your maximum profit that you stated you wanted to reach by day 10 of the month. You can either close your laptop and not trade again for the month, or you can withdraw all your profits and start again with $100. But if we want to actually be profitable, we have to make sure that we've got a business plan. A business plan with your expectations, your vision, your why, what you want to be trading, and your expected return on investment. So here we've got another example of a trading plan. So the individual strategies that will guide you in making your investment decisions. Will you use technical analysis or fundamental analysis, or both? Will you just stick to trying to decipher the candlesticks and the patterns of the chart and the support and resistances, which is your technical analysis? Or will you simply be trading the news, the fundamentals? Or will you adopt the combo method? So these are contents of your trading plan that we're discussing now. Then you may also need to write in there what conditions need to be met to trigger or exit a trade to ensure profitability. Is it when you see a doji at the top, for example, that you'll take profit? Or is it when you see that an instrument has reached a record low or record high? If that is your plan, then document it in your trading plan. Your times when you'll be trading, as we've said, the instruments to be traded. If you want to select specific instruments, again, as I said on Monday, for me, if an instrument is showing signs of falling, using the candlesticks, technical analysis and all of that, I will trade that. Because if you look at any of your charts, you'll see the same candlesticks. You'll see the doji, you'll see the hammer, you'll see the different candlesticks at the top. Same as if you look at the bottom of any chart. So, but if you have specific instruments that you'd like to be traded, then you document that that you'd like to be trading rather, then you document that in your trading plan. Your initial investment, your volume to be used. So this is something that will change over time. Remember we said that if you start with $100, you trade 10 cents per pip move until you have $250. Then you can now start trading 20 cents per pip move. By the time you've reached $1,000, you can then start trading 50 cents per pip move or $1 per pip move, dependent on your trading strategy. But whenever you decide to increase your volume or your lot size, document that in your Forex trading plan with a justification as to how you've reached that decision. If you keep documenting things and referring to that trading plan each week, so you read your trading plan each week, that will help you, or that will stop you from reaching decisions outside of that plan. If you're reminding yourself of your goals, of your times that you're meant to be trading. Let's say you've documented in your trading plan that I'll only trade between 10 p.m. and 2 a.m. Asian market time. Now, on a Monday morning, if you wake up and you decide, let me just take a look at what's going on in the market, if you're tempted to trade at that time, whereas you've already reminded yourself of the contents of your trading plan on the Saturday, that would hopefully stir up something in you that says, okay, I'm not going to trade now because that is not documented in my plan. So the trading plan shouldn't be a static document. We should ensure that we're reviewing that every week and we're updating that when we need to update that. Why do we have a personal Forex trading plan? Because it helps us to focus. When we remind ourselves of what's in the plan, it creates focus and it breeds discipline over time. Because over a long-term period, we'll remember offhand what's in our plan. And hopefully that should stir up something within us each time we want to stray from that plan. We'll remember, okay, hang on a minute, that is not what I had written down that I was going to do. So having a personal Forex trading plan also helps us to streamline decision making, because if we've written down that we're only going to trade the Euro USD, the cable, we're only going to trade the loonie, the Canadian dollar, US dollar, then we will stick to that. We won't then find ourselves struggling to reach a decision. Oh my goodness, gold is going up, I need to buy that. No, because it's not in our documented trading plan. And it also reduces stress and emotion-based trading, because if we've said that we're going to just use that we're going to trade 10 cents per point move, per pip move, then we will trade just that. Remove any emotions. Even if the market is going up by 100 pips, we see it going up, but we've documented that we're only going to make 10 pips a day, for example, or 20 pips a day, or whatever we choose to document as our plan. If we write that there, then we won't become emotional or greedy when we see the market racing up. We won't become greedy of gain. And it helps us to reduce unplanned trades when we've got a plan. It helps us to reduce the number of unplanned trades that we take outside of our time plan. So that's an essential document that is just focused on you as a trader, not on anyone else. You can't trade or you can't create a trade plan based on someone else's psychological makeup. And it's for you and you alone. But it's an essential part of the tools that you need to become a successful trader. So we've talked about all of these. So define your short and long-term goals. Create a timetable. Write a timetable of when you're going to trade and when you're not going to trade as well. You can include that. Include details of when you are not going to trade. You can document, I'm not going to trade on non-farm payroll day, first Friday of the month, because the market does tend to be a bit volatile. So you document that there. Times when you're going to trade and times when you are going to absolutely stay clear of the market. Our initial capital investment. So we've talked about this. Make sure that you don't borrow money to trade. Determine your initial investment and what your return on investment will be as well. And only invest money that you can afford to lose. Not that we want you to lose any money, but losing $100, losing $50 is far better than losing $1,000 or 5,000. Some delegates will say, okay, I'm going to invest 5,000 there, even though I'll only stick to trading 10 cents per point move. And that's not true. Because when you've got 5,000 in your account, there's a high likelihood that you will want to trade a minimum of $1 per pip move. Then you go up to $2 per pip move because you're gaining confidence. And then all of a sudden you reach the decision to trade $10 per pip move, and then the market goes against you and you lose the 5,000 plus any profit previously made. So only invest money in the market that you can afford to lose. So here we've repeated all of this, so I won't go through this again. Stop loss strategy, risk reward strategy. Stop loss strategy, what percentage of your account would you be prepared to lose per trade? You can document that again in your trading plan. You can also state whether you're going to use leading or lagging indicators. Lagging indicators, most indicators are lagging because they only indicate that the trend has reversed a few days or a few hours after the previous period, after the action has begun. You can choose to actually trade your naked charts where you don't use anything at all other than to view the chart with your naked eyes and to select your support and resistances based on what you can see. You can also include whether you're going to be placing pending orders, and never place whether you're never going to actually place a market execution order where you actually place an order on the spot. You're looking at your laptop, the market is moving, and then you decide, I'm going to buy or sell now, immediately. You can say that that's what you're going to do, that you're never going to place a pending order. On the other hand, you can say that I'll only ever place pending orders and simply close my laptop, and if my analysis is correct, then I will end up with a profit. And if my analysis is not correct, then I'll end up having been stopped out. And I'll review all the trades that have been taken at the weekend from my pending orders, and I will learn from any that have stopped me out. I'll go and review why that stopped me out. Was it because there was news that I didn't actually take into account before placing that pending order? Or was it because my stop loss was too tight? So we also determine whether we're going to use alerts to notify us when prices reach a certain point, and then trade entry indicator signs. So do we want to actually trade only when a price has hit a resistance 3 times? Or do we want to trade when a price has hit a support only once? So all of these need to be documented in our trading plan, as well as our trade exit indicator signs. Then when we talk about our trading plan and our times, do we just want to do intraday trading, where we close our trades within a day, within the day? So we could close a trade within a 4-hour candle or an hourly candle, for example. Or do we want to be a day trader where we keep our trades open for a day, for 24 hours at least? Night trader during the Asian session, or a trend trader where we're taking long-term trends? For example, as I said, where we see that, okay, that this price is approaching a record high, so I'll place a trade and then leave it to run for a week or so, or even longer. Leave it to run for a week or longer, as long as it's in profit. That is what trend traders do. They trade between long-term supports and long-term resistances. So back testing, after you've developed your trading system and your trading plan, you then can test that on your demo platform. And you tweak and tweak until you've proven that your trading plan works and that you're disciplined enough to continue using that plan. So a sample trading plan, we could fill in the details as I filled in here. So timescale, medium-term trader, intraday trader, where you're trading off the 1 and 4 hourly charts. You could also write that you're going to use indicators such as the moving average crossover. You could use the Bollinger Bands or the moving average. Then we've got pairs traded. You could write in your trading plan that you're just going to trade the GBP USD and the euro. Then you can also write your risk reward. I'm never going to risk more than X% of my capital on each trade. So I could say that I'm never going to risk more than 3% of my capital on each trade. So if my initial capital is $100, by first trade, I'm not going to risk more than 3% of that, which means that my stop loss will be at minus 30 pips maximum. Maximum. Volume 0.10 lots per pip move, which is saying $1 per pip move, if that's what I'm going to be trading. But on a micro trading account with $100, that would be 0.01 lots per pip move, which is 10 cents per pip move. So this is just a sample trading plan where I could also say I'm going to make my stop loss 30 pips per trade and I'll take profit at 70 pips per trade. So what I'd like us to do, please, is I'll stop the recording and we will take some questions before we just go off for a cup of tea, if we'd like to do that. So let me go here and I'll pause. Okay, so let's take a look at the market price action from the 28th of April. So we went up from around here. So we've been going up. So the trend has been bullish, although we have encountered some resistance. For example, at this point here on the 1st of June.
Yeah.
So at 1.28, we then came down to this support, to test this support, which was around here really. We came to test this support. We met a support solid enough to move us back up all the way to this resistance. And occasionally we've had days, we've had daily candles where the price action has been bearish, but the majority of the candles have actually been bullish since June, because we can see that they're filled with black in the middle here. So that suggests that the trend is up.
Yes.
We met a resistance at 1.34897 here on the 28th of August. And then the majority of the candles down to here were actually bearish.
Yes.
Now, as you've just said, Kevin, we've got candles ranging between here and there.
Yes.
This has just been ranging, and that's due to the fundamentals, really. Okay. That's due to the fundamentals of Brexit. Okay. Now, whether this pair, that is GBP USD cable, whether it will resume an uptrend to try and breach this resistance, that will be dependent on two things.
Yeah.
Number one, the outcome of the Brexit discussions.
Okay.
That will determine whether we're going to resume this uptrend. The second thing, of course, is the US elections, because if the dollar weakens considerably, then that would mean that the pound would strengthen against the dollar.
Yes.
Now, if we take a look at this in response to your question of how far back do we need to look at the price action if we want to be an intraday trader, and my response to you was that we need to consider the previous day's candle, the previous week's candle, and sometimes we need to consider the previous month's candle. And I'll show us something now. So next week, we've got the US elections. The last trading day of October is this Friday.
Yeah.
And we've got our daily candle for this week so far. We've had all of these bearish candles here, and then there, and then there, and then we had a bullish candle, a minor bullish candle yesterday, and then we had this bearish candle today.
Yeah.
Now, if you were trading on Monday, next Monday, which is the 2nd of November,
Yes.
you would be taking a look at this weekly candle to see
Yeah.
whether that is bearish.
Mhm.
You'd also be taking a look at the previous month's candle on which will close on Friday. What is that suggesting? And it hasn't closed now, so we don't know what it is suggesting, but we'd be taking a look at the previous month's candle to see where we close on Friday. If on Friday we close and that candlestick is bearish or a real strong doji like this,
Yes.
then that would suggest, and so I'm not making any predictions or giving any recommendations, but that would suggest that the market is going to continue down to the
Yes.
next support
Yes.
over the next month or two.
Mhm.
So
Okay.
we always take previous support and resistances into account. If we're an intraday trader, as a bare minimum, we're taking into account the previous daily candle.
Yeah.
And the support and resistance. We're taking into account the previous week's candle. And then we go down to lower candles. So if you're trading from 10 a.m., you'd be taking a look at the previous 4-hourly candle, definitely, and then the previous 1-hourly candle.
Yes.
And each of these candlesticks, whether it's 4-hourly or hourly, will have their own support and resistance.
Yeah.
And we'll always see the same candlesticks, the same sort of candlesticks at the top. Whether it's an hourly candle or a 4-hourly candle, we'll always see things like this.
So would you have people now who are putting an order in at the highest resistance, let's say from 6 or 7 months ago, ready to sell, or for the lowest support, taking a long-term view, and depending what happens on with the US election or with Brexit, so they're playing the long game. Do traders do that as well?
Yeah, yes, absolutely. That's why I've stated that some traders, and I prefer that method of trading, to just sell at a historical support or at a resistance, at a strong resistance, and leave the trade to run. Because remember, we said one of the main goals of trading for a trader is to cut your losses short by using a stop loss and to let your profits run.
Okay, yeah. Okay, yeah, yeah.
So yes, so a long-term approach is really, really good. Taking a long-term approach, and that's why I said again that one strategy could be to just go and view all of the charts on your demo platform and take a look at any that you view or that you think has hit a strong resistance, and then take a trade and leave it to run. If it's in profit, leave it to run and see how that works out for you and whether that's the best strategy for you.
Yes, yeah, yeah, yeah. Okay, brilliant. That's great. Thank you.
So did I answer your question?
Yeah, most definitely. Yeah, because yeah, it's just yeah, because it's just I wasn't sure really when you mentioned about doing the weekend kind of analysis. I think, oh, how would that work? Because I do it daily. But yeah, you've explained yourself really well. Thank you.
Thank you. But again, just some confirming. So your weekend analysis needs to occur even if you've taken a long-term position.
Yes.
And that's the only position open. You need to make sure that, okay, you've got a trade that's in 1,000 pips profit because you took that trade at the beginning of last month or 6 months ago, and it's in 1,000 pips profit. But what happened on the day the nation, the UK, voted to Brexit? We had a 2,000 pip fall,
Yeah.
which
Wow.
would wipe out a long-term trader's profit if they're buying, let's say. So
Yes.
based on that, it's essential that we still do our analysis at each weekend and
Yeah.
we prepare to close an open trade. If it's a long-term trade, we prepare to open that, to close that long-term trade. If the market, if the candles suggest that there's going to be, or if the fundamentals even suggest that there might be a potential big move against us.
Yeah. Yeah.
And remember, we mentioned the gap. Now let's take a look at this space here. I'd like to just see if I can still get that gap in place if I were to increase this chart. And if I can't get it, then I'll need to reduce this a minute, zoom out and just get it back again. And then I can just talk us through it. So do we remember I mentioned a gap? So here is the gap that's opened up. So let's see what date, what hour this was. This was on the 26th of February. And then this 4-hourly candle was on the 1st of March. So that would suggest that this candle, this candlestick closed on a Friday. And then this on the 3rd of March opened, sorry, on the 1st of March rather, opened at a much wider gap. It opened at a lower price to the closing price on the Friday. Can we see this?
Yes. Yeah.
So we can see this gap, and that's why if we've got even a long-term trade open, it's given us 300 pips, for example,
Yeah.
and we really know that, okay, that this looks good, it's in profit, we still need to do our analysis and research over the weekend to see if there's any news that might come out during the following week that might wipe away all those profits, wipe out all those profits. So we're constantly doing our analysis. But it's good that you're actually saying that you're starting to work out the times that you would trade, the times that you do your research. But the weekend is about not only looking forward as to what's coming up during the week ahead, but also looking backwards at what you did well and what you didn't do well. So again, I said that we would go into, under our terminal, we would go into our account history and we would take a look at the trades that we took, any profit that we made. We'd also take a look at any trades that we deleted. So where I've placed many buy stops or sell limits during this training, we'd be taking a look at any trades that we've deleted to see whether we should have actually left them, to see whether that was an opportunity lost. So we do all of this every weekend, each weekend, and that makes us a better trader because practice makes perfect. And if we're continually learning, we just get better and better at reaching the right decisions.
Yeah. Great.
So we keep on learning, just keep on learning. And you make less losses and more profit. Any further questions, please, from Others? Further questions? Let's just check the chat window. There are no questions. Any further questions that anyone might want to ask verbally? Further questions? Okay, let's take a look at the slides again. Can we all see the slides, please? Okay. Okay, so let's just go back here and we'll take a look at profit v cash. So again, a trader's focus has to be profit rather than money. We need to stop thinking about making money, which is what a lot of traders tend to actually view this business as. I want to make money rather than I want to make money, rather than I want to actually make a profit. When we're talking about profit, we're not just considering the amount earned in addition to the initial investment. So let's say we open an account with $100 and then we earn $100 from a weekly trade. That money cannot be considered as profit if we've spent 30 hours on that single trade or on 50 trades that we've made that week, because we've expended effort to earn that money, to earn that profit. And so the reward that we've gained is something like £3 an hour or so. So cash is simply a sum of money, and it's great to earn extra cash from trading. But again, if you spend 10 hours a day trading and you gain £10, then you've rewarded yourself with £1 an hour. And my question to you would be, is that what your time is worth? Is that what your time is worth? Or what is your time worth? If you spend half an hour a week trading and you gain or you add $10 to your account, that means that you can reward yourself with $10 for the half an hour you spent. That means that your time is worth $20 an hour to you, which sounds a bit better than $1 per hour. So again, a bank cannot give you 10% interest in a year. So if you spend half an hour a week and you make $10 a week on a $100 trading account, then that is actually profit. You've made 10% interest in a week within half an hour. So we need to focus on making profit. We're not only calculating our trades, but we're also calculating the effort, the time that we spend analyzing things. And when we're practicing, when we're learning, this discussion is of no essence. We need to spend hours and hours just learning. And there are sites that we're still going to refer you to at the end of this session. But we need to just invest in as much learning as possible, where we're watching videos, we're on babypips.com. We're on Forex Factory. We're reviewing the detail of the news that is released on Forex Factory. We're watching the price action. We're watching what happens on our charts when the exit poll is released for the next US president. We're watching our charts for currencies traded against the US dollar on non-farm payroll day, which is the first Friday of the month at about 1 p.m. or so. So we do all of this. But when we start trading live and we become experienced as traders, we need to learn to reward ourselves and to focus on making profit rather than simply cash. Because trading should be profitable. It should be a profitable business for us, where our profits exceed our losses. So, risk management, which is the most important aspect of trading. We need to calculate our risk. Some experienced traders say they don't risk more than 1% of their trading capital on a single trade. Others say 3%. Whatever the case, you need to calculate each trade and determine your stop level in the exits rules section of your plan, and then you always use or calculate your stop loss according to your documented stop level. So if it's 3%, document that, and then for each trade you calculate your stop loss at maximum 3%, not 5%. Not I think I'd better just move it to this place. So we need to just get adept at risk management. Managing our position size is also important. That is vital. Our lot size. If we place a $1 per pip move trade on a $100 account, then we're increasing our risk. And if we're placing a 10 cents per pip move trade on a $1,000 account, when we grow our account to $1,000, if we're placing a 10 cents per pip move, then it will take us longer to reach our stated goals and objectives that we've documented in our trading plan. There may be times where you can take on multiple trades. Let's say that your account is now $1,000 and you take on one trade worth 30 cents per pip move and another trade worth 20 cents per pip move. Again, if your multiple trades, if both of your trades, let's say you open up two trades and they're highly correlated and you buy both of them, then you're taking the same trade and you're potentially doubling your profit, but you're also potentially doubling your risk. So years ago, the Euro USD and cable GBP USD used to be highly correlated. But nowadays, there is a bit of lapse. And so when we say highly correlated, that means that they go in the same direction. Where one rises, the other rises. And that's because they were being traded against the dollar and they continue to be traded against the US dollar. But now, due to Brexit, the euro and the GBP don't necessarily go in the same direction anymore. So that may mean that even if the GBP USD is rising because the US dollar is weak, the Euro USD may not rise at the same rate if the Euro is also weak. So we need to make sure that we're not taking on two instruments or two assets that are highly correlated, because we could be doubling our profit, but we could also be doubling our risk. So again, when we're documenting our training, our trading plan, we need to ensure that we document our risk management strategy. Document it and read it to remind yourself of your strategy at least once a week. Now let's take a look at volatile trading days and periods and sessions. We've got the Frankfurt opening times, which is around 7:30 in the morning GMT. So that's UK time, Frankfurt opening time. That's when the Frankfurt exchange opens. UK opens around 8:30, between 8 and 8:30. That's when the UK London Stock Exchange opens. Then we've got the US that opens at 1:30. Remember, when the time goes back, then there's a week when our time is different, when we're 5 hours or 4 hours 4 hours behind the US, but then they change their times back the following week. So US opening times, the market tends to be volatile around those times, and some traders will simply trade around those opening times, and then they close their laptops and they walk away, where they've got enough equity in their account to simply just go for 10 pips or 20 pips, and then they're out for the day. Some traders adopt that strategy. The most volatile trading day is the first Friday of the month, when we have the non-farm payroll day. As I keep saying, when non-farm workers that have gained employment are released, the number released on places like Forex Factory in the calendar, as we said the other day. So non-farm payroll day, first Friday of the month, around 1:30. So that's a time where we may choose not to trade. And then we've got the Bank of England Monetary Policy Committee, the Fed's FOMC, and the ECB minutes release days. These are minutes when these various committees of the respective country central banks sit down and discuss the economy of their countries. So, Monetary Policy Committee, the Bank of England has a governor, Andrew Bailey, and he will sit with the Monetary Policy Committee and they will discuss the economy of the UK, including taking a vote on whether to raise interest rates or not. Now, when we talk about raising interest rates or not, if an economy is improving or thriving, the bank, the central bank, and the government will raise interest rates. So if during these committee meetings, the committee decides, or the majority vote to increase interest rates, when the minutes of that committee meeting is released, investors, that is the large investors, large traders, they will review those minutes and then they will take trades based on the contents of those minutes. So let's say 7 out of 9 members of the MPC decide to vote for interest rates hikes. Then that will be recorded in the minutes, and investors will view that as a sign that the UK economy is improving, and they will buy cable. The same applies to the US. If the FOMC minutes reveal that the interest rate hike is being considered by the Fed, then again, everyone will buy the US dollar, which will mean selling or shorting the GBP USD, because the USD will strengthen, which will weaken the GBP. Then ECB minutes as well. So they are released from the European Central Bank, and that will affect the euro. Then GDP. So GDP data releases, they are also volatile trading days and periods for each country that releases their GDP data. And then election days as well. Remember, we went to check Forex Factory the other day. So always check the Forex Factory calendar for important events. And you may want to actually go onto Forex Factory and just go through the detail in the calendar window, go through the detail of the different news releases, what they're about, what these different news releases are about, and why traders, why does the GDP data, what does it mean, first of all, and why should that affect different currencies? You can go and review different minutes from previous MPCs, monetary policy committees of the Bank of England. You go and review all of those. And so if anyone now comes to you and says you are gambling by trading the Forex market, you can stand there and hold a conversation with them about the UK's GDP data or the Fed's FOMC minutes release and what's going on with the US economy, and that suddenly informs them that this is not about gambling. Forex trading, informed Forex trading rather, is actually business. And it's only for those who are prepared to invest this time in actually understanding what the fundamentals mean. So based on that, there's a lot of knowledge that we can glean from these news releases and these fundamentals that will help us not just with our trading, but also in generally understanding the global economy, understanding politics, what's happening around the world in these major economies. The main time that you have massive moves in the night is when economies like China release their data. So again, if you're looking at the Forex Factory calendar. And there are other sites actually that display calendars of the Forex market or the financial markets. But if you're looking under the calendar view on Forex Factory, then if you're trading overnight, you need to be mindful of when China is releasing any fundamentals. Sometimes Japan may release interest rates decisions. So if Japan releases interest rates decisions where they decide to release to increase their interest rates, for example, that would usually be taken overnight according to their time. It would be overnight, it would be daytime in Japan, but nighttime here. So again, we'd need to be mindful and aware of all of these releases, because you may adopt a strategy where you say, okay, I'm just going to be trading between 10 p.m. and 2 a.m. when the markets are quiet, because the UK and the US is not open, which is usually more often than not the case. Yes, the markets tend to be quiet then. However, if any of these countries, Australia as well, if they increase an interest rate decision, then that could move the market overnight. New Zealand. So we just need to be aware of all of this information. And it's not beyond any of us, trust me. And you'll be really, really proud of yourself. I'm not talking about pride now, but I think you'd be really proud of yourself when you're suddenly able to actually discuss economics and to discuss global news and to say to people, trust me, this is not gambling. I have this conversation till date with some people who think, no, that's just gambling. It's too risky. Yes, it is risky, but we can reduce the risk to our capital by simply arming ourselves with sufficient knowledge. With sufficient knowledge. So let's now, we've talked about all of this. We've practiced, we've gone through that slide time and time again. We've talked about our stop loss management, but let's just talk about this again. No round figures. Let's make sure that we're not putting a stop loss on a place like 1.2350. That 50 is a round figure, a psychological level. 1.3000. Let's not put our stop loss around at a round figure, because that is likely to be hit. Calculate your maximum tolerable loss before placing each trade and never move your stop loss. Learn from any misplaced stop losses. So practice on the demo repeatedly how and where to place your stop loss. Using these principles, if it's a sell order, then you're placing your stop loss above your resistance. If it's a buy order, then your stop loss is placed below a support. And we're calculating our maximum tolerable loss before placing each trade. Now let's take a look at anti-money laundering and Forex, because this is very important. And I wrote this trade before I moved into my current job, which is really, I enjoy combating financial crime. I really, really enjoy combating financial crime, in particular cybercrime. But we're talking about anti-money laundering. Now, most brokers have to comply with, well, all brokers should comply with anti-money laundering and anti-terrorism financing laws. So, and that's why when you open a live trading account, I believe some delegates say that they were asked to provide this ID and proof of address when they were opening a demo account, which shouldn't happen with the brokers that we're using for this for this workshop. But some brokers actually do ask you for that when you're opening a demo account. I know that. But then whenever you go live, they have to ask you for a form of ID and a proof of address. All they're seeking to prove is that you are not seeking to launder funds with them, that you're not seeking to try and use their brokerage to launder funds. And as should be the case, when they're returning funds that you've withdrawn from your trading account, they'll only return that funds to the source bank account from where you made your deposit. And we can't say, okay, I've deposited this money, please can you return my funds to my partner or my partner's account. They won't do that because they cannot do that legally. So, and this is all to assist in the fight against money laundering. And I can't ring a broker and say, oh, my friend Sharon, that I'd like to withdraw money from her account because she's ill. The request has to be made by the named owner of the account. So under customer due diligence laws and know your customer laws, again, these are financial regulation laws, the broker has to ask for evidence of your bank account or credit card that you're using, evidence of ownership of your credit card or bank account that you're using to make a deposit into your trading account. Because when you go live, so you'd need to make a transfer of your $100 into your live account online. You make that transfer and they need all this evidence that you're not just a money launderer. So they request that evidence, and when you now want to withdraw money, again, you can do that in your control panel on the broker's website. So you log into your control panel when you're on a live account. This is now log in there, and then you just request the amount that you'd like to withdraw from your account once it's in profit. So insider dealing. Now, again, this is down to financial regulations. It's a form of market abuse committed by a company insider or employee. So let's say, for example, we've got Facebook shares on our MetaTrader. Insider dealing is the act of tipping off someone or taking a position in a company's shares on Forex, having been provided with information from an insider. That insider could be an employee of Facebook, could be a partner to an employee of Facebook. So if you are buying shares for Facebook because a Facebook employee has told you that these shares are going to go for cheap, or the price is going to fall to XYZ tomorrow, so you should buy them, then that is insider dealing. And the person that has tipped you off to tell you to buy those shares could go to prison. So information that is not available or publicly available that is made available by a company employee on the company's shares is referred to as insider dealing. There's nothing such as insider dealing on currencies, because the currency information is available there and you just take your trades. But if someone comes to tell you, comes to whisper, hey, look, I heard that British gas shares are going down tomorrow, or that we've had 100% profit on last year's, or that British gas has had 100% profit on last year's finances, which would suggest that the price of the British gas shares will be going up, then that person, that employee that has told you that, has committed insider dealing. And that is a criminal offense punishable by a fine and potentially imprisonment. So no employee should be telling you to buy shares in a company. So when should you go live? Well, only when you're ready. So make sure that you don't allow anyone, any broker, any voice, any pressure to tell you to go live. You only go live when you're ready to. When did I go live? Actually, I just attended a 2-hour workshop that my husband delivered. And that was it. During the following week, I funded my account with £1,000. And that's when I made that grave error of not using a stop loss on my first trade, before the rumor of Gordon Brown having resigned rescued me. So you only go live when you're ready and when you've developed a back-tested trading plan, when you've tested your trading plan repeatedly, and you're sure that you've got the discipline to stick to that trading plan. So before you can actually back test your trading plan, you need to actually draft that up, write it down somewhere, put it on your computer, and make sure that you read it over and over again. So once you've developed the trading plan, you test that, test it and test it and test it again. And then when you've got $100 to invest in Forex, which shouldn't be a loan, then you may be ready to go live. But sometimes you'll never be ready to go live. And if you're not ready to go live, then don't let anyone persuade you. Even if you've downloaded 10 or opened rather 10 demo accounts, it does not matter. You can open 20 demo accounts and keep practicing on the demo. You're under no obligation to go live until or unless you want to go live. And sometimes you may never go live. If you find that you don't deem that you have sufficient knowledge, or you feel it's too much hassle, or you feel that you're not comfortable trading, you feel that you just don't want to go live, then don't go live. Do not go live unless you reach that decision yourself that, okay, that I deem that I'm ready to go live, I'm going to give this a shot. So let's take a look at further support available, because I think this is really important. So we don't provide signals. We don't provide any advice as to when to go live or not. We're not signal providers. We don't trade. We're not a brokerage. We're not regulated by any regulator globally, by the FCA, by the Fed, or by anyone. So we don't provide signals. We don't provide advice as to when to go live or not to go live. We just aim to provide you with the skills and knowledge to become successful retail traders if you want to in your own right. You can contact me at iadebayo at the ladder back down if anything said over the course of this training has been unclear. But I'd just like to also remind us that we could go to a website called www.babypips, B-A-B-Y, babypips.com. So I'll write that in the chat window, www.babypips.com. If we could please bookmark that on our, if we could kindly bookmark that on our, sorry, I do not understand why my window isn't working. Let me just use this instead. So babypips.com. If we go there and we will view, we'll actually view our website where we can gain free education, free learning in trading, in how to trade. So it starts with kindergarten lessons, then it goes up to nursery, I think. Then it goes up to primary, then it goes up to secondary, then it goes up to graduate level or something like that. And that is a brilliant resource if you've got the time to view. Start from kindergarten, and it will tell you not only what I've shared with you over the past few sessions, but it will tell you a lot more. It goes into far more depth than I could ever hope to cover in the few sessions that we've had together. So do visit www.babypips.com for further learning. You bookmark that website. You can also bookmark www.forexfactory.com and you visit the news section. You also review the calendar every weekend and every day to see what news is going to be released. What fundamental news is going to be released that might affect your trading? Whether you choose to become a technical trader or a naked chart trader, where you're just reviewing the price action, whether you choose to become a trend trader, whatever you do, always view the fundamentals as well. When you've got an opportunity to watch the news, try and watch Bloomberg. And I'm hoping that if you turn Bloomberg on tonight or tomorrow, that you may recognize some of the terminology that is being used. There's also a site that I started sending to my I've unsubscribed from this years ago, but I've suddenly started receiving emails from them recently. Again, I don't know why, but whatever the case, it's called Forex Crunch, forexcrunch.com or so. So when they send out daily analysis of what they think is going to happen in the market, so they can say, okay, that this has broken their bearish support, that cable has broken the bearish support, and so this is what's going to happen next. and you may be able to recognize that, okay, that they say that this has broken this support at 1.300. Cable has broken this support, and so it's now going down to 1.25. Once you read that, you then go and check your chart, and you'll find that you're actually beginning to understand why they've written that, or why the reporters are saying, or the analysts are saying on Bloomberg, that cable is going, that it's got buy limit orders at 1.2500. You'll be able to understand that, because hopefully one thing that you may have gained from this course or this series is to understand how to read your support and your resistance levels. So many resources available out there. There are YouTube videos as well. I'll put these videos on YouTube, hopefully by Saturday. Put them all up there on YouTube. And I just wish each and every one of us a successful trading career, because it is really not that difficult once we can master the discipline of self.